But first, I really want to talk about what's happening in energy markets today. I don't have to tell anyone listening or watching that they're volatile. Oil is still about above $100, and given I think some of the seesawing statements from President Trump in the U.S. and responses from the Iranians, it's very unclear what's going to happen next. How is this impacting the energy markets in Europe versus the U.S., which I believe is a little more self reliant? And what are some of the big changes, or how is this impacting your business?
Yeah, a great, very obviously topical question. And the kind of differences between the UK and Europe and the US are pretty stark, which you can kind of see manifest itself on the charts right now. I think one of the big things that we look at broadly is if you think about kind of oil and gas prices, obviously they're incredibly, the price of oil and gas on markets is incredibly related to the supply. And most of that comes through the Gulf, for Europe especially. In the US, naturally, with the kind of recent shale revolution, the US is somewhat self-sufficient, especially when it comes to gas. But I think, one of the big things that we look at is when we're looking at and how it's kind of affecting our business is that the price of oil actually doesn't really affect, the price that ultimately people pay for their energy, that homes, businesses, data centers, et cetera, pay for their energy. Obviously it affects what people pay at the pump, but um, it's more through secondary effects that oil has these knock-on effects on the kind of energy economy. And it's loosely correlated with gas, and that's typically due to, it's kind of a replacement in some industrial applications. And obviously oil and gas are sourced near one another. But the main effect of oil on kind of power markets and energy markets in general is secondary due to, inflationary effects on logistics. And obviously that's been, hugely impacted with the recent developments in the Middle East. And the kind of more kind of pertinent thing around energy markets, for us in our business is the price of gas. And it's a totally different story because gas directly influences the price of electricity that people pay. It's the kind of primary fuel that goes into your combined gas turbines, which makes up a third of the fuel mix in both the UK and the US. And the way that energy markets are structured, and the kind of price discovery mechanism on energy markets is very heavily indexed towards the gas price. So what that means is when there's supply disruptions to the LNG around the world, what you see is a direct impact immediately almost on the price on power markets. And in terms of the kind of US versus Europe UK comparison, the Europe is a heavy importer of gas. And typically what happens is that you have seasons where there's injections into gas storage facilities. That typically happens over the summer. And then you've got seasons of withdrawal from those storage facilities. And obviously, naturally, during the injection season, which is now coming up, the price kind of, worldwide of gas heavily influences, ultimately the costs that Europe is paying. On the flip side, US is, with the recent shale revolution, fairly insulated, as we've kind of seen a little bit on the gas side of things. And that is going to be something to watch over the next few years, though. And the reason for that is when you look at there's a certain decoupling between the Henry Hub price, which is the price, the kind of standard price of gas in the US, and the kind of the price of GTF, which is the kind of European UK index. Those are somewhat decoupled because the US, because it's such a recent market, is slowly still ramping up its export capacity, which means that right now there's this decoupling, but we do expect that decoupling to actually decrease over time. And the kind of consequence of that is right now there's quite a lot of insulation for the US market, but not at all for the UK market. But that decoupling, as I kind of said, will look to converge over time. But yeah, ultimately, when it comes down to our business, it's the price of gas and the flows and the kind of status of the storage facilities around Europe, because that's where we're operating right now, is what really influences what we're paying and then ultimately what customers are paying down the line.
Gotcha. And maybe just to sort of again frame a picture for everyone watching and listening. $100 a barrel for oil sounds moderately scary. 150 is very worrisome. $200 is downright terrifying, and that could lead us into stagflation territory. Could you sort of put natural gas prices in those terms? And I know, I mean, just I'm not an energy expert, but it's easy to remember, especially during the Russian invasion of Ukraine from 2022 on, sanctions put on Russian energy exports, and nowadays people are talking about the closure of the Strait of Hormuz, and while some like oil processing plants have been shut down, and it might take months for them to start up if and when this conflict ends, the strait could reopen immediately theoretically. Whereas Iran's attack on Qatar's like big processing and export facility, I believe, knocked off 20% of its total capacity, and Qatar is a huge LNG exporter. That could have much more permanent effects from what I could tell. So how does that, like, again, put a kind of a long question, but like, what are the prices right now, and how is that actually directly impacting customers? And then again, like, because of this like big attack on the infrastructure, what challenges will that present, like, moving into the future?
Yeah, so I mean, right now the price of gas are basically about 50% above, 50 to 70% above the kind of usual price that was kind of we would expect around this kind of year. And ultimately that is down to obviously the disruption to the Strait of Hormuz. And you know when we kind of look at it, like beyond just crude and LNG, you've got like disruption further to not just gas prices, but a bunch of other prices as well, right? So, for instance, 30%, 34% of global fertilizers come through the strait, right? There's also effects. So that ultimately affects food. Um, and then also, kerosene is mostly sourced out of Qatar and the strait as well. So that obviously influences the price we pay for jet fuel. And further effects on that is like there's about a quarter of the world's sulfuric acid comes through the Gulf. That is needed for things like explosives, which is obviously very hot and topical right now. And also, we're finding things like copper, which is a central input to many things, including a lot of inputs in the energy industry. So, as a consequence, essentially, right now, what we're looking at is gas prices are, quite like fairly elevated, probably not as aggressively elevated as what we've seen with oil, and not quite as aggressively elevated as what we've seen through the Russia-Ukraine crisis. And that is in part because, especially in Europe, there's been a lot of measures taken since the 2021 crisis to kind of, obviously mitigate the serious effects that that crisis had and causing, kind of the disruption to the energy markets back in 2021. So that said, like essentially what we're seeing is right now we've seen an increase, but not as aggressive as what we've seen in the past. But however, one of the big issues that that probably a lot of our listeners have seen is that this disruption and this attack on the facilities themselves. These are multi-billion-dollar facilities that take decades to build and a very long time to repair. So the long-term disruption is something that I feel like isn't fully being factored in right now.
Yeah.
And people, view that, okay, look, this is a short-term thing. We'll see a taco, and then prices will return to normal. But in fact, what we're not really recognizing, and I kind of think that a lot of markets aren't really recognizing, is that there are these really severe long-term effects on global supply. That they're going to percolate and last for quite a few years.